Entrepreneurship is about creating a vision and bringing others along the journey. Good afternoon to everyone in this session. Your host for the day is Sheena, a student at BML Munjar University in Gurugram. I would like to welcome you all to the 23rd Propel Pitchfest Masterclass series. The Atal Community Innovator Center, ACIC of BML Munjar University, and Propel Incubator have created a platform called Propel Pitchfest 23 to support fresh concepts, inventions, and emerging startups. It enables interaction between startups and influential members of the ecosystem, including investors and entrepreneurs. This year, startups participating in the event will have access to $1 million USD financing pool. Well, we are eager to get going. I am happy to report that our second masterclass will concentrate on Captable 101 for startups for understanding, ownership, and dilution. We would like to start today's masterclass with an opening speech from Mr. Srikanth Prabhu, the Vice President of Growth at Qapita. For those who were not present in the last masterclass, allow me to give a brief introduction of Mr. Srikanth. Srikanth sir has over 12-year experience as a seasoned venture capitalist and an investment professional in the startup ecosystem. He currently serves as Vice President of Growth and Partnerships for Capita's executive team. Mr. Srikanth joined Tata's Trust Social Alpha to help launch and expand impactful business. Mr. Srikanth has overseen the development of 40 seed investment into full-fledged startups by the end of his 5-year term. Mr. Srikanth is currently a VP of Growth Services Startups in managing their ESOPs and transactions. He has 12 years of investing expertise. Mr. Srikanth enjoying trying to various musical instruments when he's not working with startup with the hopes of one day becoming an expert musician. Nonetheless, he will assist today. Over to you, sir.
Great. Thanks a lot, Sheena. Well, I think the aspiration to perfect those musical instruments will, not be true anytime soon, but that's a work in progress. But it's lovely to be here again. Something that I like doing and engaging. I think the last session we did on Friday was quite engaging, and it was lovely to interact with a lot of you with ideas, with a lot of questions as well. I think we will try to have the same kind of experience this time as well. So we'll kind of continue the discussion. So you can always look at this session as a continuity, as a continuation of the last one. I think the last one is where we kind of ask some fundamental questions on why should you even go for a funding? Why does a business need capital? Why does it raise capital? What are the sources from which it raises capital? And then we also discussed on what are the instrument choices you as founders have. What is stage appropriate capital, right? At what stage, what are the different choices available, and what is also the most optimal or efficient capital for various use cases, for various applications, like business as usual, working capital is a use case, but innovation is another use case, right? Taking risks, GTM is a use case. So how can you be more optimal, effective in choosing the right source of capital? Of course, at the right, whenever they're available to you, and also risk appropriate, right? So you don't want to kind of, like I said, took an example, you don't want to take a loan from a bank and fund salaries of a CTO, because the outcomes of the work that the CTO would put in would come over in the period of time. Maybe that is where you have to use equity, but maybe for a working capital or for some kind of a credit cycle, taking a short-term loan would make sense, right? So we decoded some of these kind of use cases, we decoded some of these use cases. Yeah, we decoded some of these use cases, identified the instruments, share-based, convertible instruments. We also talked about debt, grant, revenue-based financing, so on and so forth. So now that my assumption is, as founders, you have a good understanding of the various sources of capital. Now let's get into further nuances or details around it, right? We'll talk about something called cap tables or shareholding table. We'll talk something about what is dilution. You might be hearing some of these terminologies, in startup conversations, right? What is a dilution? What are valuation? How are those two related, right? What is equity, share, stake in the company? We'll try to stitch all of these concepts together. This is where also Qapita helps all of your companies to manage your ownership better, right? Cap table is nothing but a summary of ownership in the company, and we'll talk more about that. Then we'll also get into the investor rights. So remember last time I told you that there's no free lunch, right? So with money that investors give you, either they give you as a loan, which means there's a compulsion to repay, right? When I say compulsion, in the sense that if you fail to repay, then there are all kinds of recourse the bank can or any lender can have in terms of including taking you to the court and liquidating your assets, right? Similarly, an equity holder, while there might not be a time bound compulsion, or in some cases it is also the case because investors have exit clauses. They have ownership in your company, right? So today we'll be discussing about that. And along with ownership, a lot of investors also seek rights in your company, which means they would want to influence strategically which direction the company is going towards, who are the key management people who are driving it. So a lot of checks and balances the investors get because they are seeking ownership in your company, and it's not just not a loan, right? So we'll be covering some of those elements also today, which is the investor rights, which as founders you might not understand the importance of it as of today. Let's say if you're not raised any money, but sooner rather than later, you will realize some of these clauses that you sign. You must have heard of the word term sheet. What is actually term sheet, right? What does it mean for you as founders, for you as company? Those implications will have implications. Those rights will have implications in your journey. So it is better to be aware of them and then accept them rather than not be aware of it. Right. So those are the kind of broad scope that we will cover. I'll also touch a little on due diligence today. So in a way, from yesterday's from the Friday session of introducing you to the various sources of capital and talking about the various funding instruments, to now talking about ownership, cap table, dilution, valuations, and then now later talking about due diligence and investor rights. So this will hopefully give you a good perspective of what it takes for a lot of you to go into the market to raise capital and what does the process look like. Okay, so that's a little bit of a context. Let's keep the engagement going. I think last time a lot of you engaged. So I think that really helps in taking the session effectively ahead, and which also means that I know that a lot of you are following. I also got feedback that some of the aspects were quite complicated. So I'll try to autocorrect in those cases. So do keep the engagement going. In case a few of you didn't introduce yourself last time, feel free to do so now. So just type in a one or two liner about your company and maybe one topic, question or expectation that you have from this session. So I know who you are, and I also know like what you're expecting or what your question is, right? So let's do that. I did hear a lot of you last time, so I do hope that I hear many more of you this time as well. So maybe what company you're building, and one question or one even if you are not aware of things and you want to learn more about it, you can mention that. So while I do so, I'll quickly share my screen. So yeah, please keep the engagement, chat going. I will keep the chat window open here. So I will be seeing any conversations that you guys come up with. Okay, so we'll continue the discussion. So like I said, we'll talk about cap tables, dilution, and investor rights, right? So we'll take it one by one. So yeah, feel free to ask any questions at a very high level on some of these topics. So so we'll also cover a little bit. This was not covered in the last question. So I'll cover a little on what do investors look for, because that is in a way the first thing that you all should really worry about, right? What is the whole point of understanding term sheets and cap table dilution when you don't even know what investors look for and what is the story, what is the value proposition that you want to take to them, right? So we'll touch upon a little bit of that. I know Kritarth made a start with what he's building, so that's wonderful. So please keep the messages coming in. It will also know who many of you can actually take Kritarth's help if you are looking to build a community or being a creator yourself, right? So some cross-pollination synergies can also happen. So back to the agenda, we'll also then talk about cap tables, valuation, dilution. In a way, all of these are interlinked. I'll tell you how, right? And then transaction readiness, we'll talk a little about due diligence, and we'll then go into the investor rights, which is where we'll spend a lot of time. Again, I'll just give a initial heads up that investor rights topic will be technical, right? So I will try to demystify it as much as possible, but I'm trying to convey something which lawyers deal with, right? So obviously things will be slightly technical. Great. Jayant talks about building something for warehouse owner. That's wonderful. I think those are opportunities kind of untapped. So that's wonderful. And the investors get deep into the economics and right. So we'll talk about that. Okay. Great. So this is broadly the agenda, right? We already have the introduction about me that Sheena did very kindly. So I'll not bore you more. What I'll do, which I continue to do, is I have my coordinates which I'll share with you. So if any one of you have not connected, we can connect and we can share on social media as well. So this is something I did discuss towards the end of the last presentation. So this is basically kind of gives you a sense of the fundraise process. And last time I had told you that we were mostly covering these two elements, right? Where we are talking about how to be funding ready and doing an outreach, understanding what these instruments mean, what are the choices of capital, right? Things like that. So today we'll cover a lot of the term sheet elements, which is where the investor rights come in, right? As you can see here, there are other elements also which we'll touch upon. We'll talk about due diligence a bit, but we'll also talk about ownership, right? That is where all of this comes: investment, quantum, valuation, stake, and how your cap table changes over a period of time, right? So these two is where we'll focus on today. Okay. Great. Good to hear from Karan as well, who's building something in agriculture. So that's wonderful. I'm really happy to see various varieties of, ideas that you guys are all building on, right? So that's wonderful. Something Hardik is building something in health again. So wonderful. And if you need something specific, you can ask here as well as question. So this is again, what do investors look for? Many of you are looking to pitch to investors for the first time. And it's a demand and supply game right now. Obviously this is funding winter. So investors are getting a lot of proposals, and they're also not funding companies with the same frequency as they were funding maybe a year back or 18 months back, right? So how would you stand out? How would you get their interest? How do they get their excitement? Because no investor worth their salt would want to let go a good deal, right? So how would you be that good deal that comes on their table, right? So you need to go back to what are their motivations, what are they looking for, whom they want to support, what is in it for them, because they are also there to make money, right? And are you the vehicle through which they can make money is what they will be viewing you, right? So there are various elements that come into this, right? So one is the business model itself. How big is this opportunity you're going after? How deep do you know this sector or area that you're operating in? Have you spoken to enough stakeholders? And then how clear are you with the business model, the economics and the profitability, right? Many a times, even if the investors would not have much idea on those areas, it is your clarity, your understanding, that you are able to convey, that gives a sense of confidence to the investor. And that confidence can come from, like I said, your articulation, storytelling, clarity. It can also come from the kind of work you have done, the stakeholders you have engaged, right? Some of the pilots you have run. Execution is a great proxy. Execution is not really a proxy, it is the real thing, right? So if you have demonstrated past execution, nothing like it, right? But if you have not demonstrated past execution, what are the other proxies in terms of pedigree, experience, reference, market research? All of those you can talk about, right? And that kind of talks about your business model, right? Then of course, obviously your quality of your team matters a lot. Needless to say, this thing. Then coming to execution, like I said, what have you done? A lot of early stage investors are actually taking a bet on this. So if you're actually able to demonstrate, even though if I don't have a pedigree or, but if you can demonstrate execution that you've actually solved a problem in a smaller way, now you want to scale, that's a great story as well to convey, right? And then capital. So I'm covering capital towards the end because that is really a catalyst. If the other placeholders are in place, then it is just a matter of time or just a matter of, kind of opportunity that you will be able to raise money as well, because a good opportunity will always find good capital as well, right? So you also need to equally think of what is the story you are conveying in terms of your business model, in terms of your ability to execute as a team, and then obviously talking about your execution, right? So good to see a longish introduction from Narayan. So he's in the online marketplace for construction. Again, something hot. I'm seeing a lot of companies there. So good luck to you. So let me continue this, right? So again, if any of you have any questions on this, so okay, let's make it interactive. I know we've tried to make it interactive on the chat. So one word responses, right? So if you were to summarize cap table in a word or a phrase, what is cap table? I'm sure a lot of you would know already, right? What is a cap table, folks? Quick responses, like we did last time, right? What does a cap table convey? What is a cap table? What are the different elements? Capital structure. So Hardik says capital structure. That's wonderful. It is one part of the cap table, of course, right? But sometimes some cap tables might not actually convey the entire capital structure. So we'll have to understand the distinction. Shareholding numbers, very good. Shareholding bol rahe, to obviously whose share it is and the numbers, like etc. How many shares? That also gives a sense of a relative holding that everyone has, which is also very important. That actually determines how much stake. That's exactly what Raj says, how much stake equity percentage you have, because whenever someone says I'm a unicorn, I'm $100 million company, etc., you are basically talking about the absolute value of the company. But what you own in that company depends on your relative stake in that whole company, right? So if let's say you own 10% in a unicorn, then you have 100 million worth of asset or value in that particular company. So shareholding table or cap table basically conveys this information, right? It is basically called capitalization table, right? It is basically saying how your company has raised capital. That's why capital structure is a good way to talk. But most cases, cap table talks about the equity side of things, right? But a true capital structure also talks about the debt side of things, right? So both equity and debt in a way are the sources of capital. We also discussed grants last time. So they, well, of course, they don't make their way into the capital structure because you don't owe money in the grant case, right? Whereas in both equity case and debt case, there is, you owe something, right? Either you owe equity in the sense that you have given away ownership, or you have given away a liability. I mean, since you are liable to pay in the other case, right? So you will have to track it, monitor it, and that's where the cap table or capital structure kind of comes in. So yeah, Atul is right, partly saying it's investors, but hey, it need not be only investors on your shareholders, right? It can be promoters, it can be sometimes advisors, incubators, employees who become, shareholders. So all of them. So it's not just investors. So yeah, both Rajesh and Atul, of course, investors are, and they are the most critical piece here, and they are the ones who will ask for the cap table. So I understand why you are prioritizing investors, but to be complete, it's not just investors, but every other shareholder in the company as well. Okay, so great. So I think everyone or most of you kind of seem to know what a cap table does. We'll talk about valuation. Like I said, valuation and cap table and what my stake represents is related, right? Valuation is for the whole company. Cap table tells me my relative ownership, and from my relative ownership, I'm able to tell my value in the company, right? So that's where the valuation kind of works. Yes, in a way, it's augmented worth in the sense that it is the true value of the company, right? It's and of course, the equity value, obviously, you reduce the debt is what the equity holders get. But valuation is for the whole as a company. It pays basically, there are various methodologies to do it. The most first principles methodology is to look at companies' future cash flows and basically discount it to convey what is my net worth today, right? Obviously, which means that company is valued higher, or positive value means that there are positive cash flows, in the future, and everyone is backing on that fact that this company will generate a lot of cash in the future, and hence it makes sense to value them at a particular value, right? Which could be like there are startup companies which are unicorn, which means they are valued at $1 billion or maybe 8,000 crore INR, right? So that all that is based on the kind of future projections that they have in terms of the money they are able to generate for the shareholders, which is also called free cash flow, right? And what is dilution, right? So many of you said that there is a equity percentage that everyone owns, right? Do you think you will own the same equity percentage throughout the journey of the company? Let's say if Raj, who said equity percentage, owns 10% in, let's say, my company, right? Do you think Raj will continue to own 10% in the company forever? Any quick responses to that question? No. Okay. Akshat says no. Any particular reason adjusting equity percentage when new shares are created? So Kritarth brings a very good point of new shares being created. Now, what is the whole point? Why does any company need to create new shares? New shares issued, Raj says. Yeah. Why should a company issue new shares? Okay, growth is looks like growth is a wild card answer for everything, right? Last time also people were answering growth, but that all makes sense. I'm not saying no. Raise money, exactly, right? So when you actually raise money, See, when you raise money, the company needs to give you something, right? And this is like a little bit of a, even I had this, perception when I started my career in venture capital. कि share तो उतने ही है, and basically investors get share from other shareholders. But that is not the way the money flow works, right? You're not giving, I'm not giving my money to Kritarth, right? I might invite in soul shells, invest in soul shells, right? Social, sorry. Yeah. So, so then if I'm investing money into socials, that company need to give me something, right? Not Kritarth or not the founders, right? So many founders start with this a little bit of a maybe it's a very intuitive or natural way to think कि shares तो उतने ही है, उसी में सब गुजारा होगा kind of a thing. No, when I put money into the company, it's a company's obligation to issue shares to me or give me a security, which basically means I'm that much owner in the company. So the moment the company issues shares to me, obviously that means that the others are getting diluted. Why? Because they own the number of shares. Let's say Kritarth owns 50,000 shares in his company. So if let's say that shares, there were overall 1 lakh shares, so he was 50% owner. Now that 1 lakh shares, I got additional shares issued of 2 lakhs, right? So then Kritarth from being a 50% owner will become a 25% owner, because now he owns 5 lakh 50,000 divided by 2 lakhs, which is 1/4, right? 25%. So whenever you issue new shares to a shareholder, which is an investor in this case, it could be employees, ESOPs, it can be, then there's a concept called dilution happening, which means all the other shareholders, because their shares are not getting changed, will relatively have a lesser share in the company, while their number of shares are the same, right? So this concept is called dilution. Now tell me, why would anyone happily embrace dilution? Why, like you see, right? Everyone is getting diluted as companies raise money, right? So why people are happy with dilution when their percentage is actually, why is Kritarth happy that he's gone down from 50% or 20 to 25%? Although I'm sure it will not be 25%, but even say 50% to 45%. Why? Okay, Sakshi says increased valuation. Wonderful. You're all quite known. Dilution is just proportion. Very good, right? So exactly, right? So in most cases, right, whenever you're diluting, your relative percentage is coming down. Why? Because you want new people to join forces, add value to the company, right? But then you're assuming your hope is that the company's overall value is actually increasing, right? So it is like, do you want a full pizza of, let's say, I don't know, like a small hand-sized full pizza, or you want one slice of, let's say, large pizza, right? That is basically that, and nothing is right or wrong here, but it is where you want to take this thing, right? So as most of you have conveyed that the value of the company is increasing, so even on a relative terms, a Kritarth would be willing to be 50% owner, sorry, 45% owner of, let's say, a $200 million valued company versus a 50% owner value of a 1 crore company, right? That is basically, I mean, of course, the numbers are very, different, but this is giving you a sense of why dilution happens by natural course, because more people are joining your forces. On day one, who are the shareholders of the company? Very quickly, who will give me a rapid response to this? On day one, who are the shareholders in the company? Founders, right? So technically it is directors. Yeah, so two directors typically are the shareholders in the company. Of course, eventually the shareholders can be different from directors as well, and you can diversify. But those two directors need to have some stake. When you start the company, those two directors form the company and they own the company in some sense. They are also the founders or shareholders, right? But then that as the company will two people run a successful company? Again, the answer can be yes, because a lot of companies proprietorship, may even one person has run a company effectively for the years and decades, like I said. But most of these new age startups, it is in a knowledge economy world, right? So you want great people to join, you want people with capital, you want to grow faster. So there are various reasons why you want to bring a lot of stakeholders into your journey. It could be an angel investor who want to join your journey, who really believes in you, or it could be an early employee who wants to join your journey because again they believe you're onto something really big and they know they can contribute and they want to be a part of it. It can be late stage VCs who want to again take a bet on and believe that you can give them the returns they have promised to their LPs, or it can be a late stage employees who have come from other Microsoft, Amazons, and really believe their potential to create value is much higher than staying on. So a lot of people are joining your journeys and everyone is weighing their opportunity cost to come there, right? And all that you have to give them, obviously you can give them a lot of salary and all of that. By the way, all of that also comes from your equity because you're raising money for that, right? Mentors also, like Jayant mentioned, but ultimately they're joining your journey for that disproportionate value that they can get from equity itself, right? So all of that, by the way, will have to come from your 100%. That 100% will never become 150%, right? So everything is relative to that 100%. And cap table or shareholding table gives you a relative structure of how that ownership is distributed in multiple units, which are basically number of shares, which kind of gives you a sense of the relative ownership based on the numerator and denominator. Numerator is basically how many units I own, and denominator is how many units the overall stakeholders own, which is units is basically shares here, right? So that's cap tables, right? And as the value of the company, that's where the valuation comes in. As the valuation of the company increases, although your proportional ownership is getting diluted, which is the third concept here, your overall value in that company is hopefully increasing over a period of time. That's why people who start the company, how much is their value? Like they would have a 1 lakh company. It's 50,000, right? They're putting basically 50,000. Their value is worth 50,000. But the same 50,000 shares or 5,000 shares can be worth, let's say, $1 billion, right? The founders of Flipkart, are worth, I think, billions of dollars, right? Because of the value that Flipkart accrued. Now that is the, although they got diluted maybe to a single digit percentage, that their worth is so much multiplied. That is the whole magic of venture creation, venture growth, venture funding aided growth, and so that you can generate a lot of value in a short period of time. Right? So this is broadly the concept. I hope I took some time to explain this because this is extremely important and important. So what is a cap table? It's basically a account of your shareholding. It's basically summarizes your shareholding. It's a simple table which talks about who are the shareholders, how many shares do they own, and what is it in a relative sense, right? Percentage wise, right? Though how is your cap table built? It is built based on a lot of transactions, right? What is a day one transaction? When you incorporated. What happened when you incorporated? You basically were issued shares by the company because you put in the paid up capital, right? 50,000 each or 1 lakh you would have put in, you would have got 10,000 shares, right? That is basically the way the company was built, right? And that becomes the first transaction, right? Then as you got an advisor, as you got an incubator, as you got an angel investor and employees later on, you are basically continuously issuing shares or giving away shares to these people, and each of them is a transaction. So every transaction that basically deals with shares results in updating the cap table, right? And that's how also I'll talk about how cap table is built and managed on Qapita. Also, you can do it, right? Then there's also a concept of fully diluted, right? So last time, I hope a lot of you do recall that we spoke about convertible instruments. Somebody had talked about CCPS, right? Compulsory convertible preference shares, right? So the nature of these instruments says that they are convertible in nature, which means they are not in pure vanilla shares. They are not equity shares. They are either a preference shares or they are a debt-like instrument, like we talked about convertible notes, safe notes, and things like that. And they convert to equity on a certain event, right? So, but a lot of you would still want to have the visibility of how my ownership will look when they get converted, right? So that is where the concept of fully diluted comes in, which means all the dilutive instruments. Now, any of these issuing a convertible note is a dilutive instrument because they have a capability of converting to equity. The moment they convert to equity, there are shares issued, which means others are getting diluted, right? So similarly, ESOPs, right? You might promise employees ESOPs, and the moment they exercise their ESOPs or they convert to shares, obviously new issuance is happening, which means others are getting diluted. So any future event that can result in shares getting issued means that's a dilutive instrument, right? And understanding the impact of that dilutive instrument is extremely important because you might be in an impression that I own 50% of the company, but let's say the ESOPs get exercised, the convertible notes get converted, CCPS gets triggered, then automatically my 50% will no longer be 50% because I'm adding more shares into the pool, which I'm issuing to these new stakeholders who are joining me in my journey. So then that is where the dilution plays in. So this is where the concept of fully diluted comes in. I'll also cover this very quickly on the system as well. Okay. So to summarize, right? So like this also stitches with the discussion we had the last time. So what does equity represent? First is represent ownership. People who work with you, who invest in you, who advise you, who incubate you. A lot of them have they're doing it because they also want a skin in the game. They really believe in your company and they also want you to be successful, and they also want to benefit if you become successful. That's where the ownership, that's why they want to be owner in your company, right? But as you give ownership, you also give control. Now, obviously, every shareholder is an owner and also has an ability to vote, because how does companies work, right? When you say shareholder meeting, which means the shareholders are what? Obviously, in the early days, it's the founders who are the shareholders, majority shareholders, so they control the fate of the company. But in a very, very well diversified company like TCS or Infosys, it is the shareholders who vote in these general body meeting, annual general meeting, extraordinary meeting, right? General body meeting, and decide on certain key aspects of the company, right? So that's where aspect of control comes in, right? So if you're just a shareholder, obviously you're proportionally you have that much. So if you have 51% in the company, obviously I'll become a majority shareholder, which means I can literally decide the fate. I can fire the CEO tomorrow because I can just put a resolution in a general body meeting saying I want to change the key management person, right? CEO. And you are 51% owner, so you have all the right to do so, right? But a lot of investors, they don't have 51% shares, right? But yet they have a good amount of control. And that is what we will talk about, the investor rights, right? Investor rights, that is here. So one takeaway that I want all of you to take away is, as you give equity to others, you're not only giving ownership, you're also giving control, right? Obviously, they have voting rights. All the shares typically have voting rights unless there are differential voting rights, which I'll come to, which I think I discussed last time as well. And but along with the proportional shareholding voting right, which will not be very decisive in an early stage company, because the investors will not have like 10%. They only have 10%, 15%, 20% in the company, right? But the moment they sign the shareholder agreement, you also give away a lot of rights, like information rights, control, inspection rights. There are something called affirmative rights, which we'll all discuss, right? There are a lot of commercial rights. So they are additional rights that you as a founder are giving to the investors. So you'll have to be very careful about that, right? And hence, like I told you last time, equity is the most valuable asset all of you have. You have 100% of it, let's say, when you're starting. So you can keep giving away equity to get capital, which is where investors get talent and ESOPs, or have strategic relationships where you can get strategic investors or partners, channel partners, and all of that, right? So you can leverage equity for all of these use cases, but you only have 100% of it. So be very careful in giving away, because every time you give away, not only are you giving ownership, you're also giving control, right? So some things that as founders you all need to kind of worry about is, what should be the timing? How much should I raise, right? So here I basically would want to convey that there's again no right or wrong here, but timing of your fundraise is important. How much you want to raise is important. Also, you have to be very dynamic with the situation. For example, the advice I would have given you, let's say 2 years back, I would be giving you a very different advice today. Like in 2 years back, people would have raised like a 2 million round or a 5 million round as a seed round very easily if you had the right, messaging and the story. But today it becomes extremely difficult, right? Investors are very, very conscious of how much they are funding. They don't want to overfund the companies. That time there was also like a FOMO, like if this investor doesn't put in, some other investor. So it's an open market, right? Now everyone is holding back. So even like raising a 500K as a $500,000 round is also difficult for a very early stage company, right? So how much you have to put in, like I told last time, roughly have an 18-24 month runway, but maybe you might not be lucky that you might get them in the first instance. Obviously, then you can invest a smaller round first and then prove some traction basis that, and then go into the market for a larger round, right? So those are all the ways in which you can do. So that's where you define the timing and the quantum. But again, you don't want to be always in the market. So I would say you should definitely have a solid 6 months, 9 months, or 12 months of execution time where you can demonstrate metrics, traction, move the needle, so that you have a better story to convey to the investors for the next funding raise. So I think there's a question, co-founder, investor, how much control would the investor have in terms of passing a resolution? See, again, this is where the dynamics come in, right? So investor only has 40%. So let's say both the co-founders team up, and hopefully they will, then even in this case, investors might not have a lot of, but they can't be decisive. There's no decisive vote here, right? Because decisive always majority in some sense, right? But here there's also another dynamic of who's on your board, right? Typically, there's also like people on the board. In the board, typically it's majority voting of the board members, and then some resolutions are got to the shareholders, and of course shareholders also have the right to kick the board out also, right? Because ultimately shareholders are the ultimate stakeholders, right? And shareholders appoint the board, and the board appoints the executive team, which is the key management, the CEO and everyone. So that's the way it works. So there are a lot of dynamics associated. Like in this example, if the co-founders are together, I think the company is still okay, right? But the moment, and this is where you see a lot of companies after Series B stage, you'll see the board is basically asking some new professional to come. This has happened in Flipkart. It has happened in, let's say, Bharat Pay, a lot of these startups, right? And in some cases, it's very volunteer and amicable also. The founder says, I am a 0 to 1 person, and you basically now need an expert professional. Maybe they'll get someone from a consulting, who will become the CEO and things like that. So all of these things happen. And that's where the company transitions from a founder-run company to a professionally a board-run company, right? And these are all choices you have, you have basically, right? Because many a times, you can prefer just to bootstrap your company, and then you are your own malik in some sense, right? So you see when you hear like a Nitin Kamath or a Sridhar Vembu talk about their journey, they're extremely critical about let's say don't prefer getting funded, because or even second time founders nowadays, they are saying I don't want to raise venture capital because they've gone through past journeys and say I want to be my own master and all of that. But there are all pros and cons, right? You might not be able to grow faster, or and if it's completely bootstrapped and things like that. But again, a lot of people have proved those models wrong as well. So there, I think it's a very nice ecosystem where everything can work, provided you can execute well, right? So safe notes, Abhijit, are basically a convertible instrument. Like, it's basically like a simple agreement for future equity. That's what it stands for, which means this is a very cost effective and a quick way to raise money in the US companies or Singapore companies and other. Unfortunately, you can't raise safe notes in India. It has to be still a legally binding instrument, like a convertible note or a compulsory convertible debenture or some kind of an equity share, right? You can't raise safe notes for an Indian entity. There are versions like iSafe and all, but underlying they're either CCPS or they're convertible debentures. In US, it is a very simple instrument. There's not much of legal paperwork. Things are standardized. You can go to certain portals, generate the safe note, and get the money, right? So getting the money to work is easy. In India, it's still difficult. You get the money in an account, then you have to pass resolutions, allocate shares, and then you can bring it to another account, and that's how you can use the money, right? So safe note and all are good instruments where you can easily, with less process, less legal dollars, you can actually get the money quickly into the bank account and operate. Basically, that's safe notes. We can cover some offline questions on that later, right? This I covered last time. So this is a quick summary of all the types of securities as equity class, as preference class, convertible, redeemable. So safe notes, as you can see here, Abhijit, right? So this is like they are similar to convertible notes, right? And they can convert on the next round of financing. So it's also a good way that you avoid a valuation discussion. Let's let's not fight over valuation because we also haven't proven anything. You are speculating. Let's go with the execution, and later on, once we generate revenue, maybe someone will be able to put real value to based on some certain methodologies or comparables, and that's when let's get valued. So safe also avoids that discussion and benchmarks your current valuation to the future round and give that discount, right? So all those parameters we discussed last time, discount, conversion ratios, all of those elements kind of come in into that aspect. So Rajesh says, or do all votes have voting rights? Or do you mean all shareholders? Yes. A certain class of shares need not have voting rights. For example, it's still debatable whether CCPS has, but generally I see shareholder agreements explicitly mentioning that CCPS shareholders have share voting rights as if they're converted, right? So basis the conversion ratio, they will have kind of voting rights. Obviously, debt holders don't have voting rights. So like convertible note holders will not have voting rights. Like safe note holders will not have voting rights on at the time of issuance. Once they convert to shares, every shareholder will have voting rights as per their proportional ownership, basically, right? Can equity be converted? Yes, it can be. Although I've not seen a lot of use cases there, generally it is the other way, right? The debt converts to equity because you're typically not able to repay. Like all of these companies, as part of their resolutions, like bankruptcy, they will they will convert their debt to equity and then try to work the company, turn around the company and things like that, right? But I've not really heard of equity, converted to debt. But technically, maybe it's possible. Again, I'll have to, maybe we can discuss this offline, and maybe I'll put you in touch with some relevant people on that. Okay, so very quickly, this is how, this is a quick, this is like what we do on Qapita. So all of you have access, you can sign up on Qapita for free. We have a special offering for Propel Pitch, participants. So you can see the shareholders, and Qapita also has very rich way of communicating your cap table. So you can see the various share classes. You can see convertible instruments separately, preference class separately, equity class separately, and ESOPs, warrants separately. So you get a full sense of your ownership how much money they invested in. This is also extremely important, right? And the percentage, basically the stake in the company, right? So cap table should be your single source of truth. So one of the biggest problems that someone like Qapita we saw always, sometimes when you have a lot of Excel files floating around, people will be confused on what is the current state of ownership, right? Because there are so many versions of the Excel file, right? So that is what gets eliminated in a system like us, where it will be a single source of truth. So it will be only one version. Everyone sees the same version. So tomorrow you update your capital table, your cap structure, or your equity shareholdings table, everyone will get notified that, hey, your cap table has changed and this is the latest version, right? So there'll be no ambiguity, no confusion. There's a single source of truth, right? So hence it increases transparency reporting. And also shareholding table is the most important aspect that an investor looks at after understanding your business model, right? So the first thing you can see in the diligence investor asks is, what is your cap table? Who owns your company, right? And hence it's important that you be transaction ready. And in systems like Qapita, you can not only access the transactions, but also get the documents associated with those transactions, like share certificates, ROC filings, board resolution, shareholder resolution, right? Valuation report. All of these formalities which you will have to do, you can stack them all in a nice way so that you are DD ready at all times, right? So you can do a bunch of things. I'll actually cover this on the product itself, but you can do things like waterfall analysis. Now, I told you that investors typically have a preference when they invest in the company, which means tomorrow, let's say if you were to give an exit to everyone, the investors will always have the first priority. They want their capital back, right? So let's say if you generated value that is not even enough for the investors' capital, let's say, and this has happened in a few cases where investor, let's say, put in 5 crore, and let's say your company is getting sold for 6 crores, right? So investors will take away that 5 crore first, and then you are only left with that remaining 1 crore to redistribute to other shareholders, right? So typically investors have something called a liquidation preference, which means you'll have to do analysis like this to say, under certain circumstances, how much will the all the shareholders make, right? And reconciling some of these liquidation preferences. And also what happens to the next round financing, how much, is the dilution impacting, how will the convertible notes convert? If the ESOP is increased, what will happen to the other shareholders, right? A lot of these assets dilution will happen on the system. Now, because you are managing it on a system, it becomes very easy to run these scenarios and share it with the relevant stakeholders. So I'll take a pause and I'll want to practically show this as well. So I'll do that. And Rajesh asked, whenever an investor exists, is it not a bad for the company? So Rajesh, that's a very general statement you've made, right? Now, a lot of you might not agree because a lot of you are here in the market to raise capital, right? So obviously the biggest value investor adds is to give you capital to grow in that critical phase where you don't have the resources to grow, right? So obviously to say it's bad, that's definitely a wrong statement, right? I mean, it is your choice. At the end of the day, I think I would put it down as a choice, right? If you want to grow fast, you want to, you don't have other resources, then you're forced to maybe look at investment as a possible source through which you want to raise those resources to build your dream, right? So in those cases, it is obviously not bad, right? It's good, right? But let's say you are flush with money, you have a lot of resources, you don't know what you're doing with it, it's just on a fixed bank. Maybe you can put that money into your company. I will not say put all the money, but some money of that into the company, right? And then if you think you can grow in the most optimal way, and you really don't need external capital, right? And you also are in a business where you start generating cash right from the beginning, there obviously you're I would not say investor is bad, but investor is unnecessary, right? Because you're already on the way, you're generating money, and even if you want to grow fast, you're able to generate a lot of surplus, right? So there, it's a choice at the end of the day. So I'll take a pause. Let me stop sharing this and quickly show you practically how does a cap table and everything work, and then we'll quickly touch upon some of the investor terms. Okay, so I hope you're able to see my cap table screen. So this is just a company called Wannabe Unicorn, because everyone wants to be a unicorn these days. So you get a quick summary of your cap table, like how many shareholders you have, how much shares you have given out, how much company you have raised. Like this company has raised about 12.5 crores, right? That's what it's at, 125 million, and it has a 40 crore valuation, right? So you broadly know where this company is, right? And you can also see the journey of the company: angel round, convertible round, let's say seed round, Series A round. So what is the valuation of the company, what is the price of the company, shares, all of them are here, and who owns the company, right? So you have the various shareholders, investors, ESOP pool, and these are the classes of shares: equity class, the angel class, seed class, series A class. So these are all preference shares. These are all the common equity, and then the ESOP pool. So you get a very good or a clear understanding of how your company is capitalized, who are all there on your shareholders. And like I was telling you, on the ownership section, you will see the full cap table, right? So you can actually see who are the promoters. So the promoters have the common shares, and you can click on any promoter and access their details. When did they incorporate the company? How much share they issued? What price they paid, right? And you can also access all the documents, like in this case, your incorporation documents, right? Or your articles of association, the share certificate that the company issued to the shareholder, right? And things like that. I think, yeah. So all of these, right? And you can also access it for an investor, right? So this is where the investment readiness part comes. So let's say if an investor wants to invest in Series B, they want to see what did you do in Series A, right? Who invested? What was the share price, right? What was the shareholder agreement that you signed? What were the terms in the shareholder agreement? So on and so forth. So all that information is well curated and put in a way that tomorrow you want to raise the next round, everything is here. You don't have to go anywhere else, right? And all of this information is, like I said, cap table is nothing but a sum of all transactions. What are these transactions? All the issuance. A lot of you said the new shares are getting issued, or shares are getting transferred between two parties, or convertible notes, warrants, or safe notes. These are getting issued. So all of them are recorded chronologically, right? And because they're recorded chronologically and accurately, you will get the cap table that will basically say who owns what in the company and which transactions ensured they have that much share in the company. Right? You can do a bunch of things on the system because everything is managed through transactions. You can go back in time and put an as of date. Let's say 2 years before, how was this cap table? So I can view the cap table. You can see only the promoters were there, right? And let's say if I remove it, you'll see the current cap table. So you can see how your cap table has evolved across these stages. You can say at angel stage who was there on the cap table. So you can do a bunch of these permutation combination. You can also add parameters like invested capital or IRR, multiples, what is the current value of the investment, and things like that. So all of that information is there. It's very, very comprehensive as a you have all the information in one place. And I told you the scenarios, so I can run very quick scenarios saying, let's say tomorrow this company is raising a next round of capital. How much will the new? So this is where the dilution comes in, right? So you can see I am raising, like say 20 crores at 80 crore pre-money, right? So if I am raising 20 crore at 80 crore pre-money, how much is the dilution to all the shareholders? Quick question. If I'm raising 20 crore at 80 crore pre-money, how much is the dilution or how much equity is the new investor getting? Anyone? Fastest fingers first. I can share the template, Rajesh, but in Qapita, you don't need a template. You can just get a view like this very easily done for your company, and then you can play around. It's a do-it-yourself kind of a product. I'll share the links, as I said. So for getting the template, you can sign up here. I'll just share, and you can just mention BMU as the reference partner code. So all of you will get a free access to Qapita, basically, where you can manage all of this, through a system. So even your investors will get something more professional than something on a spreadsheet. Okay, is he right? Sorry, I think I was, let me send it to everyone. So just mention code BMU. So just you can sign up on this and you can just mention the code BMU. So everyone will get access to Qapita for free account. And using this, you can share it with the stakeholder. Share it to your investors and all of that. So Shruti, unfortunately, you're wrong. So 20 crore with an 80 crore pre-money. So any other answers to Shruti's response? I'll tell you why it's different. No responses. Nobody wants to give it a shot. So the question is 20 crore investment. The new investment is putting 20 crore and pre-money valuation is 80 crore. And with this, I'll also introduce you to the concept of pre-money. Okay, looks like, okay, good. So Mihir got one thing right, that the post-money valuation is 100 crore, right? Because 80 crore and investment is 20 crore. Let's say I value your company at 80 crore and then I'm saying I'm putting 20 crores additional into the company. Obviously now the value of the company is 100 crore, right? Because 80 crore, it was already there, future cash flow value, and 20 crore hard cash I'm putting in, right? So great. Some of you have got, so pre is 25, the pre is always lower. So pre is 80 in this case, 80 crore. Post becomes 80 plus 20, 100. So how much money I am putting in? 20. After putting in 20, how much is the value of the company? 100. Is that all clear? So I'm putting in 20. The company was worth 80 crore. So after I put them in at 20, it becomes 80 plus 20, 100. So after I put in, the company is worth 100 crore, right? So if I'm putting 20 in a company which is 100 crore, how much equity should I own? So current mentioned 20%, right? So that's it. So because in this company, after my 20 crore was put in, the company is worth 100 crore. So in that 100 crore, 20 crore is what my contribution is. So that means it's 20% is my contribution, right? So that is exactly, you can see here that 20 crore over 80 crore pre-money, automatically it will convert to say 20%, and it will also calculate the exact number of shares. Now this is the tricky part. How do you calculate the number of shares? Because for that you need to first look at what was the shares before, and then you have to calculate how much shares I have to give that is worth 20%, right? So it's a little bit of a goal seek or a back work with which you calculate it, right? And because I'm giving 20% to the shareholder, means I have to dilute the everyone else, right? Because where will the 20 come? Because the 20 is coming from the 100 only. 100 is not becoming 110, like I told you, or 120, right? So the remaining 20% will come from the other shareholders' proportion. So while their number of shares is not changing, so in this case, this founder earlier had, let's say, 21, 22% in the company, because they issued new shares to this worth 4,900 shares, and the shareholding is increased. I have to give new shares to this. So I have to the proportion has decreased by so much and so. So that clarity you are getting it here very easily, right? That how much is the dilution, right? And you can also see ESOPs can also be increased. So ESOP I put back to 10%, which also means to this extent, this is new shares that got added, which means I am basically diluting from the existing shareholders. So this is the concept of dilution, valuation, and the cap table, right? I hope this is clear so far. So all of this basically can run on Qapita. The other thing that I told you was the waterfall, where you're basically simulating, let's say this company gets sold tomorrow. How much is the value worth for each shareholder, right? So this is based on the liquidation preference or the various priority in which that value is being redistributed to the shareholders. And that is typically dependent on something called a liquidation preference. So always the latest class, Series A, let's say, is higher proportions. Convertible is highest because that's a debt. First, you repay the debt, then you repay the senior most class, Series A, then you repay seed class. So like that, you see, finally, founders are the last one to make the money. So in this case, let's say this founder is not even making any money because all the earlier class, they are senior, they are getting the priority. That is where the liquidation preference comes in. Okay, so this was just to tell you, these are all things that you should be aware of. You will go through it if you are raising money. So of course, I know it's a webinar, so we can't really get into the details or ensure you have picked everything. But broadly, if you got a larger idea of what is cap table, how does valuation, what is dilution work, and how all of these financing round scenario or liquidation preference scenario, you'll be able to get an understanding of how some of these things work. Percentage contribution versus percentage ownership can be negotiated. Yes, I mean, that's basically how much capital you're putting in and how much equity you get. That is exactly the negotiation that happens during the term sheet stage, right? So, and that's why the best effective negotiation happens if you have multiple term sheets or you have multiple interested parties for your deal. Then you can be the picker, right? You can say, hey, this person is giving me a better valuation. You either match that valuation or go with that, right? So there's a healthy competition that's happening. There's a demand and supply. It's a market, right? Of course, if there's only one investor and one, then that becomes an issue, right? You can't really negotiate in those cases, right? So, or, you'll have less leverage to negotiate. Okay, so that was very quickly on the system. So a lot of, it kind of hopefully made sense to a lot of you. I'll brush past a few because I know we are running late. So I'll kind of brush past a few other aspects. So let me just share my screen. So I hope you can see my screen. So very quickly, I will cover due diligence. So once you understood cap tables, you understood dilution, and you can use the link to sign up for your free account. And we also have benefits from AWS, Freshworks, some 50 plus partners, benefits worth $300,000. So you can avail all of that through your Qapita account. Now let's move on to what is due diligence. So due diligence is the process investors go through with the company to ensure that they are they are ready to be funded, right? So they have, when they say ready, one is obviously the business model and assessing whether you have a future potential, right, in terms of executing a model. Second thing is also whether you have done, followed all the norms and regulations, right? Be from a finance point of view, legal point of view, compliance point of view, and so on and so forth. So have you filed your taxes? Have you filed your returns? I mean, your annual statements, right? Have you conducted board meetings? Have you passed the relevant board resolutions for certain decisions, right? And also, have you issued shares to your shareholders? Have you conducted board meetings, shareholder meetings, and things like that? So all of them are relevant, right? So that is where diligence comes in. So a legal due diligence is a comprehensive assessment of any legal risks that are related to the company. It can have a legal risk. I mean, it can also be legal, accounting, and business. All of them will cover financial risk, business risk, technological risk. So they will want to ensure you are not covered with any risk. It's all makes sense, right? So these are all the different types of diligence that you need to be worried about, like financial and tax, right? Which is called FDD, financial due diligence. Then there's LDD, legal due diligence, right? Here they look at your books of records, your accounting standards, every detail, right? Your invoices, your employment agreements, wherever there's a financial implication, they will look into it, right? Legal will look at all the company law element, all the legal paperwork, contracts, any legal paperwork of material impact will be viewed, like all your board resolutions, shareholder resolutions, all the filings, valuation report, a lot of the legal things will be looked at. Technical is for deep tech companies. Let's say somebody wants to look at your IP. How have you, built they want to do a code review, they want to do an architecture review. All of those comes into, or they want to just test, ask you to, comply by certain tests and give the results and things like that, right? Then there's commercial. This is what most founders, investors do. Commercial is what they do. Everything else they typically outsource, right? They'll bring a CFO firm for this, or an accounting firm. They will bring a law firm for this. They'll hire a deep tech agency for this, right? Commercial is what they will look at. Like, does the unit economics work? How will you make money? What is your margins? Things like that. And nowadays, a lot of investors also are very clear on their ESG norms, like environment, governance, have you followed the right gender policies to environmental policies? All of those will come into, and no investor want to be seen in companies which are non-compliant with ESG norms, right? So this is also becoming extremely critical. So all of this becomes part of your diligence. So you have a checklist, and this is something we are offering to all the Propel Pitch participants, where we'll organize all of your records that I just mentioned in a way, and give you the right assessment of whether there are any gaps, any requirements, and things like that before you go for funding. Okay. So now let's talk about these are all some of the mistakes. Like, you don't have the share certificates given out. You don't do the filings. You don't conduct board meetings regularly, right? Your signatures are missing on contracts, right? Employment agreements are not there. You are claiming they are employee, but there is no employment agreement to back it. ESOP documents, there you're promised that your ESOP pool is there, but you're not really followed through and created the ESOP policy and given out ESOPs. So all of these are basically non-compliances that come out in the future diligence. So you better be prepared with all of these elements. So now let's come to the term sheet. I know we have run late, so I'll cover very briefly some of the elements of the term sheet, and then we can have any Q&A also after this, right? So term sheet, like I said, comes in between the process. This is where you have an indication to invest. There's an interest to invest, but then subject to due diligence, the investment will actually happen, right? So it's like an engagement before a marriage of sorts, right? That's the way I will define the term sheet. So you'll get a sense of how much they're putting in, what is the valuation, stake, what are the rights, which we will cover now. And you can also compare multiple term sheets and go for the effective one, which makes sense in your journey. So term sheet will have pricing and valuation, right? What's the share price? What's the pre-money valuation? What's the post-money? Like we just saw the example. In convertible instruments, there can be valuation, cap, floor. Then various instruments it will tell, which is it a share-based instrument? Is it a convertible instrument, common shares, preferred shares, convertible notes, safe, etc. ESOP pool, how much ESOP you have to allocate, which investors would ask you to allocate, right? How much pool size, 10%, 15%, and investor rights. So we'll cover a little bit of this in the next 5 minutes. I know I'm taking longer, but hopefully this will be of value. So what is the rationale, right? So like I said, see, investors are what are they doing? They are basically betting their money on your dream, right? To that extent, investors might not have a lot of say in the company's fate, right? Because at the end of the day, they're investors, they're minority shareholders to a large extent of the early stage game, right? But and hence, they are putting all their LP money, which is also their hard-earned, curated money from their LPs, into your dream, right? So they also need those checks and balances so that their money is not going down the drain or put into the bad use, right? So that's where they will seek these investor rights as a mitigant or as a way to hedge their risk of putting their money in your dream or allowing you to execute, right? And that's where you can see one is they are here to make returns. There's no two ways about it. Investors are not here to do charity, right? Even if it's a not-for-profit like incubator, they also want money, returns basically, right? And they also minority, which means they can't decide the fate of the company. They are at the end of the day minority shareholders, right? Only a CEO, etc., can define, or founders will take the company in a direction. Investors are more helping in that process, but they might not be the decision makers in many cases, in the early stages at least. Once it obviously becomes majority shareholder, they will also determine this, right? Then corporate governance. It's always good to be compliant with corporate governance norms. So with these rights, in a way, investors are pushing you to be better governed. You have the structures. You will have a finance person, CFO or a VP finance. You will do all the regulations and things like that, right? So that you need to be worried out, consider is understand the objectives very clearly. They are here to make money. They want you to be successful. So that's the best part, right? They will become successful only because you become successful. So the incentives are aligned, right? But they also want to ensure you follow the relevant guidelines. You don't take shortcuts. There are enough examples, I think, this year or last year actually, where you have seen so many cases that have blown up in the ecosystem because of fraudulent accounting practices or books and records not being in order and things like that. So these are all there's checks and balance with the investor, with the term sheet they have, right? So this is a quick summary of the investor rights. So this is again not to overwhelm you, but even the simplest of the term sheet that many of you will sign will have all of these elements. So it's very important for you to understand that whenever you're signing a term sheet, you're giving away some part of your control, and your control manifests in these elements. For example, there are a lot of protective or control related rights like board representation. The investor says, I want to have 3 people on the board, and you agree to it, then they particularly they possibly can decide on a lot of matters that the board can decide on the in the company, right? Let's say there's a non-compete, non-solicit as a part, which means it prevents you as founders to quit this company and open a competing business, right? Employment agreements can also have non-compete, non-solicit. There are reserved matters, which are basically strategic veto rights, which means certain decisions you can't take without the investor's explicit approval. Now you might actually be like wondering what is this, right? I mean, this is my company, how can the investors dictate terms? But this is exactly coming back to the point that and these are not the day-to-day issues, these are more the strategic issues. It means, let's say you want to bring another investor or raise more money. All of this will basically require the existing investors with those rights to approve or give you a written consent, right? So these are also called veto rights. Inspection information, where they have more say in coming, visiting your premises, asking you for information. Like an investor will ask you, give me a monthly MIS. You just can't say no if you have signed up this, if you've given the information right. Meaning they have a right to ask, and you are obliged to give them the information they asked for, which already is documented in the term sheet or the shareholder agreement. Then there are a lot of commercial rights. All of these basically want to maximize the returns the investors can make in the perspective of their shareholding, right? So like preemptive rights, which means it's giving them a right to subscribe to new shares, right? That's why it's called preemptive or pro rata, which means let's say you are raising new capital tomorrow. If your existing investors are preemptive, right? They will have the first right to subscribe to those new shares before you give to someone else. Right? And to the extent of their proportion, right? Promoter lock-in is where you are locked in, right? If you leave the company before a certain time, then there's a good chance that you're not able to liquidate your shares. You might not have vested your shares, and it's locked in. Basically, you need their consent before you can sell the shares. So that's a promoter lock-in. Right of first refusal is where tomorrow, let's say you actually get to sell the shares, they have the first right to refuse, which means they can buy the shares before anyone else can, right? So these are all some of the privileges the investors are getting along as part of the shareholder agreement, and most of them are standard. You can't really negotiate out of it, but you have to manage these risks or manage these control elements effectively. Something like anti-dilution, right? Where let's say I told you that we all said that the value of the company is continuously increasing, and hence even if I'm lower shareholding, I'm increasing in value. But in these funding winter situations, you can actually do a down round, which means although I'm issuing new shares, I'm issuing it at a lower valuation than the previous round, which means the effective ownership percentage is actually coming down in this case. The share price is actually coming down, right? Which basically means your value is increasing, right? Decreasing. So in those cases, you also have an anti-dilution, right? So that you are not like you just came in the last round and your value decreased, right? So to prevent those cases, you have an ability to subscribe to fresh shares or adjustment in the number of shares so that your value is not diluting. That's where the anti-dilution comes in. And last, we discussed liquidation preference. This is where the various classes of shares have different priorities in which it gets paid out, right? So hence the senior most class, like in this case, Series A, was the highest class. So they will get the capital first and then the next and then the next. Only if something is left, it will be redistributed to everyone else. Right? So these are all things you need to be aware. And then the exit clause, right? So these are again when an investor comes in, they're not there to join your journey. It's not a real marriage in the sense that they don't want by design they don't want to be there forever. They want to be in 6 years, 7 years time frame, and they want to exit, right? So that is what is mentioned in the exit clause. Basically, that is a period with which you have the opportunity to give them exit. Failing which, if you don't give them an exit in 6, 7 years, they have various choices, and these are all their choices where they will push you to do an IPO, right? They will push you to do a strategic sale, right? Or they can get a buyer and push a strategic sale. They can go for secondary where they can sell it to anyone, and even if let's say they are your competitor, they have the right to sell because it has exceeded the exit period, right? They can ask you to do a company buyback if the company were having cash, but in most cases that might not be the case. They can also drag. This is an extremely sensitive thing. Like they can also drag your shares. Let's say if they find a good buyer and they want almost majority of the company, they can drag your shares also to the investor, which means they want to buy a larger share. They not just buy from the investor, they can buy from the promoters also. That's where the drag, it's a little bit of a coercive, right? But that is also available to the investor if the exit clause gets triggered, which means 6 years, 7 years, whatever it's mentioned in your shareholders agreement or term sheet, right? This is something definitely avoidable. There's also something called put option where investors have a right to put their shares to the founders and force the founders to buy their shares and put their own personal money, especially if there are like cases like fraud or things like that. But this is again not a standard practice. So anything that brings personal liability to you, you should avoid. So I know we are running late, so I'll take a pause here. I can share this presentation. My intention was to introduce a lot of these rights to you, but obviously it will take a lot of time for you to digest, absorb. I can share this slide, and then if you have specific questions on any of these rights, you can reach out to me. Like I just skim through, right? These are all the various rights. Like preemptive is where they like a good investor will keep investing in the company that's doing well in every round, right? That is a preemptive right. So you should watch for some of the pro rata whom to give. Don't give these rights to everyone because then it becomes a nightmare to take approval from all of them, right? This is your promoter lock-in and reverse vesting. So even founders go through vesting and their shares are locked. Again, to be fair, that makes sense because investors want to exit before the founders, right? That's what they perceive, right? But there are exceptions where investors have agreed for founders to exit also partially, not fully, right? Then ROFO we discussed, right, where they have a right to first refuse any new issue of shares or transfer of shares, actually, in this case, where the existing investors can actually subscribe to them rather than giving to a third party, right? Drag along and tag along. Tag along is something interesting where for a minority shareholder, they have an opportunity to participate in any exit or in any secondaries, even though they are minority, because they might not have any rights, but they can have a tag along right, which means tomorrow, let's say the company is getting, you're selling some shares, you also partner so that, it's not be like the promoters change and you couldn't do anything about it, right? So minority shares are protected through it. Drag along, we just discussed. This is an opportunity for investors to drag the promoter shares or other shareholder shares also if they find a good buyer. And typically this is when exit clause happens, gets triggered, right? And then this is the liquidation, anti-dilution, where it's a protection given to investors if there's a down round or the share price is coming down. The current investors are compensated for the down round, basically, right? And then there's something called liquidation preference, also very important, where like I told you, right? There's a good chance all your value can get wiped out because of the liquidation preference, because the investors will prefer recovering their money before the promoter makes any value, right? So I told you that 5 crore, 6 crore example, right? Where you might getting very peanuts, but the investors can recover all of their money first before you get anything, right? So that's the liquidation preference. So that's pretty much it. I'll take about, I know again, I had to rush through the last part. Again, ideally I do it in a separate session, but I know that, we had to kind of sandwich it into this. But the idea was to give you these pointers so that, you think about it. I'll share this presentation to the organizer so they can share it with you. And both the presentations actually. So if you have any specific questions, we can actually have a more offline chat kind of a thing, right? I've already shared. So Kritarth asked the question, are these to be explicitly mentioned? So these are all there in the term sheet. Now the issue here is term sheet is typically English language, which a lot of you will understand. But the fine print is actually there in the shareholder agreement. That's where each of the line in the term sheet is like half a page in the shareholder agreement, right? So you have to be very careful in understanding, are there any issues and all of that. Most of the templates will be standard and quite, standard by industry standards. But then you have to be careful. There may be some caveat here or there. That's where you need legal help. That's why, maybe in early days, a lot of people do safe rounds and all for this reason. So that a lot of these legal hassles are avoided and you just get the money in the bank early and, start executing, right? So, but yes, all of these are need to be written in white and black for them to be, kind of practiced in reality, right? Dipendu was, do DPIT tax benefits appeal to investors? DPIT is more for the company. There's the whole thing about angel tax and those elements. I'm not the expert there, but DPIT approval is for the company because you can avoid your corporate tax for a certain number of years. There's some waiver there. Second is you can give ESOPs to founders. There are some more relaxed norms that they have. So obviously, Dipendu, you have, it's better to get DPIT registered. There are various advantages that you get, right? So that's pretty much it. So I'll wait. If there are any questions, I can take a pause. You can also ask, can unpause, unmute and ask as well. And Qapita, I told you, you can manage cap tables. We also help you with ESOPs. You're attracting talent. You can use us to set up your ESOP scheme, and everything is digital, like you just saw, right? It's very easy to use. And then we also have a marketplace. This is later on in your journey where you can buy and sell the shares, right? And so you can sign up on a free account of Qapita as part of our partnership with BMU. You just you get a free cap table account, you get access to credits, and you also become part of a founder community. So all of that you can do. So you can sign up. I just sent you the link again, right? So does not have the first degree network of angels and VCs. What are the ways they can find the right investment entities, right? So good question. The thing is, information asymmetry is reducing over a period of time, right? So gone are the days where you needed to have a warm introduction to the investors to pitch to them. Right now, there are umpteen opportunities, right? There are programs like this Propel pitch. There are angel platforms where typically most of you will get an opportunity to pitch because they are also hungry for deals, right? Only these mainstream VCs, they'll be very selective on whom they want to engage with. But there are various avenues, there are various events, there are various networking pitches where you can get your impression done and then follow through. See, the fundraising doesn't happen in a day. It has to be a continuous collaborative effort, right? And everything you do is reinforcing each other. Your presence on social media, you're going to an event, you're taking part in an accelerator like this, right? You coming up with good knowledge articles, podcasts. All of them are basically building your story, which will make you more investable because people will have a lot more data points to assess you, right? So I would say be out there, get visible, and then you'll and obviously you should have a good product, you should have a good plan, good business model. All of those are existential. But this distribution play is where you have to get out there, build a good LinkedIn profile network. All of those basically come in. But yes, you're right. Good connections will obviously mean you can get in ahead of the game much earlier, right? Dipendu asks, do investors choose AIF categorization for tax benefits? Again, we need to understand. See, there are taxation involved with AIFs. There are also pass-through entities. And, investors might use vehicles in Mauritius and all of that. All of this will not impact your company, right? As long as it comes in as equity or debt or those instruments, you can use the capital, right? But typically investors choose their place of incorporation for tax benefits, like many people would have done Mauritius, or nowadays Gift City also in Gandhinagar, right? That is also becoming a lot of companies are choosing, and they also want to ensure funds are incorporated there. It's still early days, nothing has significantly moved. But there are AIFs are incorporated in India and governed by Indian laws. So a lot of funds that you are pitching in India are in AIFs only. So obviously that model works and there is no issue. I think the issue comes when you starting using foreign money. Right? So that's where the taxation and all is beneficial if you are investing from from an entity like Mauritius or no other geographies. So great. I know we are running late. I mean, we already kind of overpassed. So do connect with me. I think I shared my coordinates earlier. Let me share them again. And you can also email me. I can also share this deck. So I know again a lot of things we covered. I know it was a little bit heavy duty towards the end. But the idea is to give enough hooks so that you can engage on these things future, right? And do check out Qapita. You can leverage Qapita. We also do investor connects every month. So happy to have you access all of these benefits and benefit from this. So I'll take a pause, and I know maybe Sheena is late, but thanks for this opportunity. And any questions, feedback, we can take it offline.
Thank you so much, sir. Thank you so much for enlightening us. We want to thank you from the bottom of our heart for the wonderful learning experience your masterclass gave. I want to thank you for taking the time and making the effort to attend this session. Moreover, I want to thank everyone who joined in on this discussion and kept it lively and involved. I want to thank everyone for investment partners, ecosystem partners, participating partners, and supporting partners for helping to make today's session possible before calling it a close. Thank you so much, sir.
Great, thank you, everyone. Sure, I'll share the PPT. I got some direct message. I'll share the PPT to the organizers, and they can share it with everyone, or you can just email me and I can still share that. Yeah. So great. Thanks, everyone, and all the best for your venture journey. Let us know if we can be of help. So feel free to reach out anytime. Thank you.
Yes,
Thank you,
thank you, sir.
Srikanth.
Thank you.